Pramod, over to you.
Hello, folks. Welcome to Marcellus webinar on our new fund launch. It gives me great pleasure to welcome you all and introduce you to our new strategy, Kings of Capital. It's a financial sector focused fund, as some of you might have realized already. And this follows our successful closure of our small cap fund, the Little Champs portfolio. Again, I'll take this opportunity to thank you all, particularly the investors in the fund and also our distribution partners in helping close this in what has been fairly difficult times during the lockdown. So many thanks for that. So without much ado, I'd like to introduce the portfolio manager of Kings of Capital, Shah. A little bit of introduction about Tej before I hand it over to him. Tej, as you know, is the portfolio manager. He's been a portfolio counselor with Marcellus for the last 2 years. Prior to joining Marcellus, Tej worked at Mayfield, a Silicon Valley headquartered venture capital fund, which manages $3 billion globally and about a couple of $100 million in India. Tej spent 2 years as a part of Mayfield's India investment team, covering multiple sectors, including financials, and he was being at the center of India's evolving venture ecosystem. Prior to Mayfield, Tej was part of the equity and capital markets team at Ambit Capital, where he was involved in the end-to-end execution of IPOs, QIPs, and buybacks. Tej is a chartered accountant and has cleared all levels of the CFA exam. He holds a BCom degree from Ahmedabad University. Gives me great pleasure to introduce Tej. Over to you, Tej.
Thank you, Pramod. I'll share the slides and I'll take all of you through each slide.
Just one sec, Tej. Pankaj, could you please put Tej's the camera on for Tej so that they can see Tej's face? Carry on, Tej.
Yeah. So like all of us know, right, over the past 6-7 years, it's been pretty challenging for the financial sector as a whole. Every year has seen some of the other challenge pop up for the financial sector. It started with Raghuram Rajan's asset quality review in FY 14-15. Then there was demonetization in FY 16, introduction of GST in FY 17, FY 18 saw ILFS, and FY 19-20 have already seen Yes Bank and DHFL. Now, in what was already a very deteriorating condition for the financial sector, on top of that, we saw the COVID-19 lockdown. And that made the situation really even worse by putting further pressure on the weaker lenders. However, paradoxically, it is investing in lenders during these times that proves to be highly rewarding. So storylines, headlines are very similar in every financial crisis. Comparisons are drawn to the crisis of the 1930s. Solvency of banks is questioned every time there is a financial crisis. Similarly, business model of NBFCs is questioned. However, smart investors end up making a lot of money when they invest in the midst of a crisis like this. So whether it be the crisis of the late 90s or whether it be the 2008-9 global financial crisis, if someone would have simply invested in the bank Nifty during the time, they would have made not only relative returns better than the Nifty itself, but also absolute returns in the vicinity of 25-30%. And that is whether they would have invested before 3 months of the bottom of the crisis, after 3 months. All of those things in terms of timing don't matter. However, that leads us to 3 questions that need to be answered. Question 1 is, how do we know that the crisis is bottoming out? Is this really the bottom? Is it not? Where are we in the cycle? Question 2 is, even if we know that this is the bottom, how do we know which stocks to select in within the financial services sector? What should we look out for? Do we look at PE multiples? Do we look for value? Do we look for growth? Do we look at management teams and brand? What sort of filters should we run? And finally, after getting 1 and 2 right, the third question is, how do we know when to sell? Is it a buy and hold sort of a strategy like CCP? Do we exit at some point of time? And what will the exit triggers be like? So we'll take you through the slides and try answering each of these questions in the coming slides. I'll hand it over to Saurabh to take you through this slide.
Fantastic. So just one request to our tech team. Pankaj, if you can just get Tej's camera switched on. I've got video going from my end, but for some reason I can't see myself. Tej, is your video on?
Yeah, my video is on as well.
So just request to Pankaj and the tech team if you can figure out why nobody can see us, because the audience is trying to see us, right? So in the meantime, I'll carry on, and hopefully the tech team can figure out how to resolve the video issues. So folks, why are we launching this fund in the middle of a pandemic? Those of you who attended our 11th or 12th March, I forget exactly the date, I think it was the 11th or 12th March. That was the day when the market fell 14%. You might remember this slide, right? We had said on 12th March that the foundations of India's recovery are in place, and we'd used this slide. And people had thought that we have sort of lost our mind, right? We have lost our mind. We hadn't, right? We've thought it through quite carefully. We believed on 12th March. We believe today that we are beginning a new economic. We are beginning India's 5th economic recovery in 40 years, right? So why is that? Why are we so confident about that? If you look at India's past, in the last 40 years, we've had only 4 economic booms, right? Can you see Pramod? Can you see the slides?
Yeah, I can see the slides.
You can see the slide. You can't see us. Yeah, folks, we know you can't see us. We're trying to figure out why that is. The tech team is trying to figure out why you can't see us. Our cameras are turned on for some reason. You can't see us. We're trying to fix that. In the meantime, we'll carry on with the slides. The slides are more important than our faces. Whilst I would love to believe that seeing my face will earn you money, it's the slides, the intellectual property that will help you make money. So in the meantime, let's focus on understanding the content rather than worrying about our faces. So in 40 years, we've had 4 economic booms in India. The first boom took place 82 to 86. That was India's first economic boom after independence, believe it or not. The second time our economy boomed was 93 to 96. Third boom was 2003 to 2008. And the final economic boom, the last boom we've seen in our country, was 2009 to 11. These are the only 4 periods of rising economic growth in our country, and the red chevrons, the red arrows indicate the same. Now, before every such period, before every period of rising growth in India, came a recession in America. The first recession in America, which is relevant for us, is the 79, 80, 81 recession, just outside the timeline of this chart. 1990, 91 was the same. So was the second recession in America. Immediately after that came our second boom. 2000, 2001 came the third recession, and after that was the third economic boom in India. Obviously, Lehman Brothers was a recession, and today America is in recession. Now, it's important before you invest in a financials fund for you to understand why does this happen? Why does India boom every time America goes into recession? And to turn it around, why does India never boom without a US recession? Right? Why is there a 1:1 correlation? There are 2 things that are important for us to understand before we invest in a financial fund. Firstly, the cost of money. The cost of money is driven around the world by the US 10-year bond yield. The US 10-year bond yield is the world's risk-free rate. As you can see in that blue line, it's been falling our entire career. Thank God for that. But more importantly, folks, whenever America goes into recession, the US 10-year bond yield drops by 2 to 3%, right? You can see every time there's a red arrow, see how quickly the blue line collapses. This time around, it's happened as well. So when we began this calendar year, the US 10-year bond yield was pushing 3%. It's 0% today, right? 300 bips drop in 6 months in the US 10-year bond yield. That means the cost of money globally has come down. In our country, it's come down by 200 bips. The cost of money in India is down by 200 bips in the last 3 months or so. Our estimation is that we'll get another 100 bips of rate cuts over the next 8-9 months. Over the next 8-9 months, the cost of money will fall by another 100 bips or so. 300 bips drop, which is the global cost of capital drop, we'll see in our country as well, right? So that's the first critical driver of economic recovery, and it's super important for the financial services sector to see this sort of drop in the cost of funds. The second driver of an economic boom in our country tends to be low oil prices, right? That's the orange line in this chart, right? So no surprises, when America goes into recession, the price of oil drops, right? If after all, if after all the world's largest consumer of oil, if the world's largest consumer of oil goes into recession, oil prices drop by 50 to 80%. You can see this in this chart, right? See the sharp drop in 84, 91, 2000, 2000, 2001. 2001, the price of oil gradually slid from the high of 2000 to 9/11, basically fell by 50%. And 2008, we were down by 70, 80%. This time also, this year as well, price of oil has halved, right? Why is price of oil having a big deal? Because the drop in the cost of oil gives us a 3% of GDP boost, right? It's happened this time as well. The bulk of the government's fiscal largesse was the oil price drop, right? There is something more left there given the drop in the cost of oil. So India booms when we get cheap oil and cheap money, courtesy of US recession. We are in that phase, right? At one level, it's a no-brainer to say that after the contraction in the economy in April, May, you can't possibly see any other thing but back to rising growth. So we highlighted this slide in March. It's important that if you are thinking of investing in the financials fund or generally in India, you need to understand this. This is critical, and this has laid the foundations, as we said on 11th March, gap down day. This has laid the foundation for the beginnings of an economic recovery. So now back to Tej for you to understand why in such a climate of low and falling interest rates, of recovering economic growth, why it makes sense to invest in stellar financial services companies. Tej,
Thanks, Gaurav. So, and that slide ties in nicely with where are we in our growth recovery in the financial sector itself. Like we've seen many times over in the past 20-25 years, we've seen periods of crisis followed by periods of recovery, and that is inevitably followed by a period of economic boom. And this keeps on happening in India over and over again in the financial ecosystem. However, what is important to note is not all sorts of lenders or all financial institutions go into the recovery period or in the period of economic boom in the same shape and form that they entered the crisis in. So, for example, if we would have gone through the 2008-9 crisis, then a lot of poor quality lenders suffered on the liability side as well as the asset side, and not all types of lenders are able to recover at the same rapid pace during the period of recovery. And that is where we've focused on. To answer question number 2 on our previous slide, what sort of lenders or what sort of financial institutions do we pick? If we were to take the example of HDFC Limited in the crisis of the late 90s or the early 2000s, they entered the crisis with 16-17% ROEs. However, they exited the crisis with 23-24% ROEs. So like in any other crisis, NPAs of HDFC Limited doubled. NPAs went up from 0.5% in 96, 97 to 1% in 99. P ratios halved. P ratios came down, crashing down from 20 times to 8-9 times. And therefore, the share price had a double impact. One was because NPAs doubled. Second was because P ratios halved. However, what is interesting to note is what happens post the crisis. Post the crisis, the loan book growth starts accelerating. ROEs are better off than they ever were. And because of that, P ratios start normalizing. And HDFC Bank also, same storyline during the 2008-9 global financial crisis. NPAs increased from 1.5% to 2%. P ratios came crashing down from about 28-29 times to 18 times. And they exited the crisis with ROEs, which were much better off than the entry ROEs. And the reason that this happens is these high quality lenders, they not only have enough capital on their balance sheet to survive the crisis, but they also are in a position to raise capital, and they have the ability to raise growth capital to gain market share post the crisis. So while 80% of the NBFC sector got wiped off in the crisis of the late 90s, HDFC Limited was able to raise liabilities at will and was able to raise liabilities at the interest rate that it was willing to offer to these lenders. Similarly, on the asset side, during such a crisis, because competition gets completely wiped off, these lenders are able to pick the credit quality of their choice and lend to these guys at the interest rates that they want to offer. This leads to better asset quality, and this leads to better net interest margins. Eventually, as a result of this, ROE start improving, P ratios start normalizing, and investing in these high quality financial companies gives you three different benefits. One is acceleration in loan book growth. Second is normalization of NPAs. And finally, normalization of PE multiples. To take you through how we've created this portfolio, what sort of filters have we run, and to answer the question on what sort of financial companies do we invest in, we started out with a universe of about 100 companies. And these were companies in the financial sector, obviously, which included banks, NBFCs, insurers, brokers, and asset managers. Then we ran our forensic filters on these 100 companies. So in some ways, this is very similar to what we do in CCP and LCP. However, I'll take you through the forensic filters, which are a bit different because these are financial companies in the coming 2 slides. And we eliminate about a third of the universe over here itself. So about 30-35 companies don't pass our forensic filters. And that is because these are companies where corporate governance is an issue, accounting quality is an issue, and we can't trust their numbers. So about a third of the universe gets eliminated here itself. Then on the remaining 65 stocks, we run our capital allocation filters. Here we try and assess whether over the past 6-7 years, these companies have been able to generate returns on capital well above cost of capital. So we look at about 10-11 ratios, and we try and assess whether these companies have been able to do profitable lending over the past 6-7 years, whether net interest margins have improved or not over a period of time. Secondly, are they providing enough for NPAs? Are provisioning coverage ratios good enough to protect the balance sheet? Have they generated return on equity, which is better off than the cost of capital consistently over the past 6-7 years? And over here again, half of these 65 stocks, more than half of these 65 stocks get eliminated in this filter itself. And we finally come to a consolidated list, a short list of 23 stocks. And it is here that most of our research effort, most of our time is spent on. It's on doing deep work on these 23 stocks. So filter number 1, we try and filter out companies which have poor accounting quality, poor corporate governance. Filter 2, we try and remove companies which have not generated returns well above cost of capital. And in our qualitative work on these 23 stocks, what we try to figure out is whether these companies have sustainable competitive advantages, as a result of which they will be able to generate returns on equity which are much above the cost of capital. And the way we try and do this is we do a lot of independent channel checks. So for banks, we'll try and meet collection agents. We go and meet DSAs, branch officers, credit officers. Similarly, in the case of insurance companies, we'll go and meet actuaries. We'll meet insurance agents, brokers. And the same is the case with asset managers and brokers. We try and corroborate what the management is trying to tell us by speaking to people who are doing the work on the ground in all these different fields. So we go and speak to management teams, we speak to CEOs, people who were previously on the board of directors. And that is how, of these 23 stocks, we've created a portfolio of about 12 stocks. And to take you through the details of our forensic filter, how have we built this filter? So there are about 11 ratios, and we rate all our financial companies from D1 to a D10. So D1 stands for decile 1, D1 being the best, D10 being the worst. So the ratios that we use are, say for example, fee income as a percentage of net interest income. So in the case of Yes Bank, for example, fee income as a percentage of net interest income was 54%. Versus for other lenders, it's between 25 to 30%. So for example, for a Kotak, it's at 28%. Similarly, contingent liabilities as a percentage of net worth. Say for Yes Bank, it's 23 times versus for a Kotak, it's 4 times. And it's on these ratios that we try and rate all these financial institutions. We compare banks to banks, NBFCs to NBFCs, housing finance companies to housing finance companies, and so on and so forth. So it's a comparison between peer sets. And then we try and rank them between a D1 to a D10. So from an academic exercise, it looks good, right? But what we've already tried to do is we also tried to find out the correlation with stock price returns. So if we would have created a portfolio of financial companies which rank between a D1 and a D3 and invested in them over the past 3-4 years, we would have generated a 10% CAGR. Similarly, if we would have created a portfolio of financial companies which rate between a D8 to D10, that would have generated a CAGR return of minus 25%. So a simple mechanical way of creating a portfolio just on these forensic filters would have generated a massive 35% alpha over a period of the past 4-5 years. So we realized that this is an extremely powerful filter to weed out companies basis accounting quality. Not only in terms of accounting quality, but also in terms of direct correlation to share price returns. To take a case study, an example of a company on which we run our forensic filters was DHFL. So in the case of DHFL, just on the basis of its FY13 to FY18 published financials, this was when DHFL was growing 20-25% year on year. FY18 was when DHFL was at its peak. It was well before the thing became completely public and well known. So there were 3 red flags which were primarily came to our knowledge. One was similar to Yes Bank. Fee income as a percentage of net interest income, Yes Bank amongst its peers was the second worst. So it had a fee income as a percentage of net interest income at 25%, which was second only to Reliance Home Finance. And what this does is, this improves and makes you believe that the P&L is much better than it actually is. So profitability improves, return on equity improves, profit margins, net interest margins improve. While the balance sheet may deteriorate at any point of time in the future. Similarly, treasury income as a percentage of net interest income. Again, it's pumping up the P&L. The P&L looks much better than it actually is because of these non-core accounting items. And again, in this case, DHFL was the third worst amongst its peers. Another interesting thing that DHFL did was, it routed a lot of expenses through its balance sheet rather than the P&L. So, for example, it issued thousands of crores of zero coupon bonds and NCDs, the interest on which was being set off against securities premiums and general reserves. And as a result of this, again, the P&L looks much better than it actually is. So these ratios, finally, what that resulted into was that DHFL was a D10, which is the worst score on our forensic model for 2, 3, 4 years before it came out in the public. And that is why we continue to use our forensic model as the first filter to eliminate companies, weed out companies which have poor quality accounting. Now, coming to our portfolio construct, the way this portfolio has been constructed is that it's a 60-40 sort of a mix. 60% to lenders, 40% to non-lenders. And what that does is that the lenders give us over a period of time a good alpha, and the non-lenders in the portfolio reduce the volatility in the portfolio. So what we look at for within all these subsectors is, 1, we look at good accounting quality like we discussed, 2, ability to generate ROEs well in excess of cost of capital, and 3 is, in each of these cases, they should have high barriers to entry. So for example, in the case of life insurers or general insurers, we look at long-term actuarial risk frameworks which have generated good results over not only the past 3 or 5 years, but 10, 15, 20 years. So good underwriting across multiple cycles. Similarly, in the case of asset managers and brokers, we try and look at business models which have strong pricing power and great amounts of operating leverage. And as a result of that, if we were to look at, say, FY20 as an example, while lenders faced a challenging time in the past 2-3 months, we saw that retail brokers have been growing 70-80% year on year. Similarly, general insurers, because 50 to 60% of the business comes from motor insurance, saw that they were seeing a lot less claims than they were seeing in the previous years. Because the country was under a lockdown for about 3-4 months, And obviously because of that, vehicles were not plying the road. General insurance saw a straight flow through to their bottom line because of lower claims on motor insurance. Similarly is the case with life insurance. Every time you see a pandemic or a health crisis, health insurance awareness and life insurance awareness improves drastically. So we see that recovery for these non-lenders, not only in terms of business performance, but also quicker recovery in terms of stock prices. And as a result, the portfolio's construct is such that there is not a high amount of correlation between these subsectors, despite being a portfolio which is focused on the financial ecosystem. So we've tried to capitalize not only on the lending industry, but also on the structural savings growth story in India. And to make that point even better and emphasize on this, if say someone would have invested in the portfolio 2 years ago, if they would have invested on 1st of April 2018, this financials focused fund would have made 12% returns versus 5% for a Nifty or a minus 2% for Bank Nifty. And this is with volatility, which is lower than the index, ratios which are much better off than the Nifty and the Bank Nifty. So this is despite the last 2 years having seen almost everything. We've seen ILFS collapse, Yes Bank, DHFL, and now the COVID crisis. And the reason for this is the table on the bottom left. Our core focus on fundamentals and high barriers to entry results in a portfolio which over the past 5 years in difficult times having generated 19% earnings growth and 19% ROEs. And the numbers for the indices are extremely dismal, so not even worth comparing. 7% earnings growth, 1% for the Nifty. And as a result of this, this portfolio would have generated even in FY20 returns which were much better off than the Bank Nifty and the Nifty, and even in absolute terms, which were much better off than the rest of the stock market. And despite being a financials focused fund, we get a lot of questions around volatility. We get a lot of questions around correlation with the indices. So despite being a financials focused fund, the standard deviation is lower than the index and Sharpe ratios are much better off than the Nifty. Similarly, because of the non-lenders being 40% of the portfolio, the correlation of the non-lenders is just 26% with the Nifty versus 95% correlation of the Bank Nifty with the Nifty. So we believe that over a period of time, as the fund progresses over the next 2, 3, 4 years, the volatility will be similar to what we have seen in the last 2, 3 years, much lower than the Bank Nifty. And similarly, the returns will obviously be much better off because of our core focus on the fundamentals of the portfolio. Now to answer question number 3, which we saw earlier, when do we exit or when do we sell? How would we know that? So we've got 2, 3 approaches on how we think about this. Approach 1 is that we invest in such a portfolio during a crisis like this, and we hold on to it for 3, 4 years. And previous crises have shown us that holding on to such a portfolio for 3, 4 years gives us good absolute returns, good relative returns in the vicinity of about 25%. And if we sell out 3, 4 years out, if someone would have invested in 2008-9, sold out in 2013-14, they would have saved themselves from the drag that happens 3, 4 years out. So 3, 4 years out of a crisis, the Bank Nifty gives maybe say minus 2% or 5%, and we can save ourselves from the drag on the portfolio by exiting 3, 4 years out. The second approach is that as fund managers or as portfolio managers, we look at the number of IPOs or the number of QIPs that are happening during the year. So every time in the past decade, we've seen a large number of IPOs in the stock market that has been followed by a large drawdown. Whether it be 2007, whether it be 2010 or 2017, the biggest drawdowns have always been preceded by a large number of IPOs and QIPs in the market. And that is linked to a third approach. When there is easy money available to all types of lenders, all types of financial institutions, that is a sign of a raging economic boom in India. So if we look at the CPCD yield and treasury yield and the spread between these two numbers, and we see that the spread is narrowing, that is a sign that poor quality lenders are able to raise money at rates which high quality lenders are also able to raise at. And once we see that, that is a sign of a raging economic boom. So once we identify or look at these 2-3 factors, we have a couple of options in front of us. One is 3-4 years out, when we see a raging economic boom in India, we start tilting our portfolio towards more higher quality lenders, say towards the HDFC banks or the Kotaks of the world. The second option is that we tilt our portfolio towards the non-lenders within the portfolio, that is towards the insurers, asset managers, brokers. And what that does is, like we saw in the previous slides, it improves or reduces our volatility on the portfolio and gives more stability to the portfolio in case of a drawdown. And that is how we've thought about what we do 3-4 years out once the economy recovers, once we've made 20-25% sort of returns on this portfolio. And to finally take you through our thought process on the sort of stocks that we've selected in the portfolio and why we have selected them. Let me take you through 3 case studies. One is on Bajaj Finance, second is Kotak, and third is HDFC Bank. So in all 3 of these companies, in each of these companies, 3 themes are common. The 3 themes being great corporate governance, good accounting quality. Second being ability to generate returns on capital well above cost of capital and historical demonstration of the same. And third being high barriers to entry. The difference in each of them is they've created each of them has different strengths, and they've created different barriers to entry in their own different ways. So for example, in the case of Bajaj Finance, why we like Bajaj Finance, over the past 10 years, they've made huge amounts of investments in technology and big data. And that is the barrier to entry for a Bajaj Finance. Unprecedented amount of investment in data analytics. And today they finance about 75% of India's consumer durables. So the amount of data that Bajaj Finance has on about 4.5 crore consumers in India, and to add to that, financing 70 to 75% of India's consumer durables every year, they can not only at a very granular level know what these customers are doing, but can easily cross-sell about 15 to 20 more products which they already have with them. So for example, using this funnel of consumer durables financing, they cross-sell home loans, they cross-sell mortgages, LAP, that is loan against property, gold loans, lifestyle financing, digital financing, etc. And 70% of their existing disbursements are made to customers whom they've already financed in the past. And to take one more example, the granularity to which they go. So there are about 10 lakh doctors in India. Now, Bajaj Finance has mapped out each and every doctor in India, and they know which doctor passed out of which college and when did he pass out. Then they've graded each of these colleges. So if a doctor has passed out of the top 100 colleges, they gave him a score X. If he is passed out of the bottom 100 colleges, they will give him a score Y. Then another filter that they apply is whether he lives in a city like Mumbai, whether he lives in a rural town, and when has he finally passed out. Basis this, they've categorized each of these 10 lakh doctors into 600 different clusters. And this is on only one product. They've done this for each and every product. And as and when time goes by, as they keep gaining market share, as they keep financing these guys, their data only keeps on improving. And this, when you combine it with the liability side of Bajaj Finance, its ability to raise capital at the rates which are amongst the best in the NBFC industry, that is a very powerful combination. On the liability side, you're able to raise capital at the lowest rates. On the asset side, you have the technology of a small fintech player and the agility of a startup. And that is why we keep on holding to Bajaj Finance and keep adding to our position even in CCP in Bajaj Finance. The second example is Kotak Bank. What Kotak has done over the past 25 years is just brilliant capital allocation. In some ways, even better than HDFC Bank. So over the past 25 years, they started out with a small retail NBFC business and then a securities business. What they did was they started learning from the global best in each of the industries that they wanted to enter into. So they entered into a JV with Ford Credit. They entered into a JV with Goldman. They learned life insurance from Old Mutual, and so on and so forth. Then once they got the banking license in 2002-03, they gave an exit to each of these players. And now all subsidiaries of Kotak Bank are 100% owned. And once they got the banking license, they had two challenges in front of them. One was, being a retail-focused lender, how do they build out a corporate loan book? And second was, how do they build out a large liability franchise which is focused on granular retail deposits? How do they build a granular CASA franchise? So again, this problem was attacked brilliantly by way of capital allocation. During the crisis of 2008-09, when everyone was receding from the corporate lending market, Kotak doubled its corporate loan book. In 2008-09, they took the call of doubling down on the corporate loan book. And they grew again in 2009-10 by 50%. So that is how they achieved a good, balanced, diversified loan book mix. Similarly, in 2012-13, they started offering higher interest rates on savings accounts at 6%. And then at that point of time, there were questions around whether you can sustainably build a CASA franchise by offering higher rates. But over the past 7, 8, 9 years, they've now become the best in terms of having a CASA franchise. At 56%, they have the highest CASA ratio amongst the major Indian banks. So over the past 25 years, they've not only built out multiple financial services businesses by learning from the best in the world, but they've also built out from being a retail-focused lender, to being a diversified lender and building a great CASA franchise. Now, finally coming to HDFC Bank. A lot of us know about their systems and processes, and that is what has resulted into the past 25 years of unsurmountable growth, gain in market share, and impeccable asset quality. And they've continued to focus on mitigating risk and focusing on processes, and that eventually leads to the outcomes and the numbers that we see. And to take an example, right, how do they focus on these systems and processes? One of the group heads at HDFC Bank that we spoke to, he reported to Aditya Puri for 15-20 years. And he told us that an Axis versus an ICICI versus an HDFC, maybe an HDFC Bank would be just comparable to these people on a person-to-person basis, or in terms of bench strength, or in terms of talent. However, where HDFC Bank won the race over the past 20-25 years was on systems and processes. By simply following these processes, they've not only kept continuously grown at 20-25%, but they've grown at this rate by keeping NPAs at about 1-1.5%. And that is why we believe, whether the CEO remains the same, whether there is a change in CEO, whether there is an internal candidate or an external candidate, HDFC Bank is on an extremely strong footing, at least for the next 2, 3, 4 years. And finally, coming to the fund structure. So we'll offer two options to all our investors. Option 1 is a 2.5% fixed fees, and option 2 is 1.5% fixed fees with a 15% profit share over a 10% hurdle. And the minimum remains the SEBI minimum, which is 50 lakhs. Yeah, so that is it from my side.
Great. So we've got a whole host of questions coming in, Tej and Saurabh. So I guess you'll have to get ready for a bit of a ride. Yeah, I mean, they keep coming in. I'll try and bunch them up into a few categories so that we can try and take as many questions as we can. The first question is, the people have sort of burnt their fingers in thematic funds. Historically, there was a wave when there were infra funds, and there was a wave when there were pharma funds. Of course, pharma funds have outperformed in this rally, but for the long run, the experience of having invested in sector-specific funds haven't been particularly great, naturally because it offers poor diversification. And at the same time, a financial-specific fund adds its own source of volatility. How would we justify someone investing in the Kings of Capital Fund? And particularly given, say, in the Nifty, most indices, including our own CCP, has a fairly high weightage towards financials as well. and how do we justify the need for a financials only fund?
So I'll have a first crack at that. And Tej, you can then take over from me. So folks, we heard this line of argument when we launched Little Champs back in August, 29th August, 30th August, when we launched this line of argument. A lot of people told us that, small caps is a graveyard. Everybody else gets buried. You'll also get buried. And in fact, Kings of Capital is not even small cap, right? Kings of Capital is sub BSE 500. So we heard this dire, pronouncements about how various people had lost money. And obviously, we are very sensitive to that because our job is to protect money more than anything else. And as we've built this portfolio, the Little Champs portfolio, invested it. And remember, before we launch a portfolio, we use our own money to make sure that we know what we are doing here. We've become even more doubly sure of the mantra that we apply to consistent compounders, which is that there's only actually one mode of investing in India. At one level, it's not as if there's any difference between large cap, small cap, financials, non-financials. That one mode of investing in India, the only mode of investing in India that works is you have to look for companies that are clean, right? Where your forensics, your research on the promoter suggests he's not a chore. That's the first pillar. Second pillar is look for companies that are selling products, services, which are essential to life in what is still a very poor country. Whilst $2,000 might be our overall per capita income, that's flattered by people like you and me. The vast majority of the country makes do on income much lower than that. So look for companies that are selling essential products and services. And the third thing is look for companies with barriers to entry higher than Mount Everest. Right? All three of these, especially the forensic bit and the barrier to entry bit, takes a lot of work. Right? If you do the work or your fund manager does the work, you'll make money. If you or your fund manager don't do the work, it does not matter what you invest in. You can do large cap, micro cap, mini cap, infrastructure, financials. You will get destroyed in this country. Right? The whole ecosystem in the stock market, the bond market is meant to help you lighten your wallet. Right? There's nobody out there who's going to try to help you make money. Right? So the first focus, whatever we do, whatever you do with your money, has to be look out for fraudsters. Tej, if you don't mind, just go to that slide where the forensic picture you were showing, right? That was a super slide, I thought. There's a remarkable bit in that forensic slide. So we'll just look at Tej's forensic slide and assume for a minute that neither he nor we in Marcellus have any intelligence, that we are duffers, and look at the bottom left panel. What that is telling you is if all that we do is focus on the top 30% of financial services companies, right? Assume we have no intelligence about, barriers to entry and when to enter, when to exit, all of that, assume goes to hell. We just focus on the forensics piece. You can see you'll make money in financials. Right? And by the same token, for those of you remember the corresponding slide for the broader BSE 500, the same piece holds true. The top two tiers on accounting quality in the BSE 500 disproportionately make more money than the rest of the BSE 500. So at one level, this whole debate around the sector fund is actually somewhat distracts from the point that what we are building here is a high-class portfolio built around clean accounts, essential services, and very high barriers to entry. The second reason for doing it, remember, is how India has evolved, right? 2, 3, 4 years ago, whoever tried a financial services fund had no choice. He just had to do lenders. There was nothing else listed in our country till 3, 4 years ago in terms of non-lending financial services. You didn't really have too many life insurers listed. You didn't really have too many general insurers listed. You didn't have any asset managers listed. You didn't have almost any wealth managers listed. So the financial services ecosystem is itself mushroomed from just being lenders to a more all-round sector. And this will continue, right? The saving story, basically the story you and I are part of as we sit on a Friday evening discussing investing. The saving story is going to run for a long time. 95% of India's wealth is in real estate and gold. That's RBI study, super study, the 2017 RBI household finance study. 95% of India's wealth is in real estate and gold. That's not tenable. India will shift from 95-5 to 80-20. 80% of our wealth will be physical and 20% will be financial as opposed to 95-5 today. India's stock of wealth is around 10 trillion. That means today 9.5 trillion is in physical assets, barely half a trillion is in financial assets. As we go to a more 80-20 picture, India's financial assets over the next 10 years will go from being half a trillion to potentially 2 to 3 trillion. We cannot, I cannot not participate in that process of investing in good quality insurers, asset managers, wealth managers, right? So that's the second piece to consider. Leaving aside the focus on forensics and rigor on forensics, the second piece to consider is there's a sector shaping up in front of you. You yourself are contributing to the growth of the sector, and millions of people like you and me will drive the growth of the lending sector and the insurance sector and the asset management sector. The third piece to consider is look at the background in which we are doing this. Historically, 70% of our lending ecosystem has been public sector banks, right? All of you know that 70% of our loans are PSU banks. PSU banks, as all of you know, make no money, right? The State Bank of India hasn't made an ROE above cost of capital for, I think, 20 years, right? So these banks perpetually live on taxpayers funded dole out. You and I get taxed, we give money to the government of India. Government of India slams it into the PSU bank balance sheet, and the PSU banks then take away 70% of the loan book of the market. The government has no money to put in PSU banks anymore, right? Fiscally, you know what the state of the country is, right? Given the fisc, it is impossible to now conceive how the government will support the 70% of the lending ecosystem, which is PSU banks. Even if you assume 70 ka 10 years mein 50 ho jata hai, right? The Air India situation, right? Where PSU banks exist, but sort of half dead. And even if they go from 70 to 50 in the next 10 years, 20% market share opens up. Who will that market share go to? That 20% that will open up. Will it go to middle of the road NBFCs who struggle to hold it together? Or will it go to Bajaj Finance? Will it go to middle of the road private sector banks whose books are as cooked as Tej was indicating, the names on Tej's forensic slides? Or will it go to HDFC Bank and Kotak Bank? We don't think it requires a great leap of imagination to figure out that as we go through a consolidation in the lending universe, not just PSUs, but even in the private sector lending universe, the top lenders will win big. You heard from us over the last 2 years how in every sector in India, whether it is paint, whether it is footwear, whether it is glass-lined vessels, whether it is biscuits, cooking oil, 1 or 2 players in every sector in India are ending up taking home 80-85% of the sector's profits. The same thing will happen in lending over the next decade or so. We cannot not play that dynamic. The consolidation in lending, as the government support for the PSUs gets taken away, and as the weaker private sector guys get weaned out, people who are in the zone of thuggery and zone of opacity, those private sector lenders get decommissioned. So structural opportunity on the saving side, as you and I save more through financial products and less through real estate and gold. And we want to play that through insurers, asset managers, and wealth managers. And structural opportunity on the lending side, this is the time to do it. You got to start after a crisis because you're getting the benefit of a full economic cycle in front of you. So to our mind, you're getting a high quality portfolio in a sector which I think several of you have already told us is 1/3 of the market. You're getting a portfolio diversified across the best lenders, the best asset managers, the best general insurers, the best life insurers, the best wealth managers. Why you wouldn't want to invest in it, I honestly can't figure it out. So Tej, over to you. Any other thoughts on this subject, please feel free.
Yeah, just to add to that, this is a sector also ripe for consolidation, because if you look at any other sector, right, which are the weakest players in any other sector? They are the ones which are highly leveraged. So in this sector, given that it is a sector which is inherently leveraged, the pace at which consolidation will happen will be much more quicker than what happens in other sectors, because weaker NBFCs, because weaker banks don't have the ability to keep on raising liabilities. It's far off for them to keep on growing balance sheets. They'll struggle to raise liabilities to survive through the crisis. It is a sector which will consolidate much more quickly during a crisis like this than many other sectors.
Great. So the next question is about the inherent volatility in financials. I think you did touch upon it somewhere during this slide, but given the number of questions that have come on that, how do we intend to manage this volatility? How do we intend to manage this risk? if you can give a sense of what sort of drawdowns do you expect? For example, if say, let's see, if we get a second wave of COVID and extended lockdowns and stuff, or perhaps some other crisis, given the inherent nature of the leverage nature of financials, how do we intend to manage? And if say toggling is part of it, what sort of churn ratios can one expect in this sort of a fund?
So Tej, if you don't mind, I'll have a first crack at that.
Sure.
So just stay on this slide. So firstly, folks, as Tej has indicated, the fund is toggling between 60% lenders and 40% non-lenders. So general insurers, life insurers, asset managers, and wealth managers. So obviously, if you do have, let's take the promote scenario, which is second wave of COVID, another bout of irrational hysteria, like we were gripped in March, where people thought the whole country is gonna somehow go fall off a cliff. The non-lenders obviously will fall less, right? The non-lenders will fall less, and that buffers your portfolio. But at one level, you don't want too much buffering, because then you and I can't get those opportunities like we got in April, May to load up on great lenders. So let's take the CCP as a case study of how this portfolio will work, right? So for those of you who are unaware, between January, February, March, the market fell around 30%. Consistent compounders fell 12.9%. In spite of Bajaj Finance falling, I think 70%, HDFC Bank Tej falling 50%.
Yeah.
And Kotak Bank falling something as much, right? So the three lenders in our portfolio collectively would form around, of the three lenders added up, would be around 28% of CCP. Fell the best part of 50%, and yet CCP fell 12.9%, right? Not only did that buffer us on the downside, through April, May, we got a great opportunity to load up on three world-class lenders as the market panicked. So we want a little bit of volatility. This is stock market. This is not a fixed deposit. We want a little bit of volatility. What we don't want you to do is suffer the 30-40% drawdowns, which other fund managers have made you feel is part and parcel of life in our country. And the structuring of the portfolio will give you insulation from massive drawdowns. At the same time, it will open up opportunities for us to buy great lenders every time India goes through a panic like COVID. Tej, over to you.
Yeah, so if someone say would have invested even in FY20, right? If someone would have invested in this portfolio on 1st April 2019, so 100 rupees invested on 1st April 2019, at the end of the financial year, that is on 31st March 20, which I believe was, I think, the lowest point in the stock market, 100 rupees would have become 90 rupees. So that's a 10% drawdown, versus the Nifty was minus 25%. So minus 10% versus Nifty is minus 25%, and the bank Nifty was minus 37%. So this buffering is a result of, one being, of course, the non-lenders in the portfolio, and second being high quality lenders in the portfolio.
Pramod, over to you.
Sorry, and the next question is around something that goes against Marcellus's, basic grain of not trying to time the market. This seems like it's all about timing. What has changed, and how do you justify this change?
So, we can't time the market. We don't try to. What we can do, and that's why we exist and we manage your money, is we can spot investment opportunities in industries which are consolidating. We've done exactly the same in Little Champs, folks. In Little Champs, we've gone and bought sector champions, whether it be in glass-lined vessels, GMM Fodler, whether it be aliphatic amines, alkyl amines, and that ability to realize that a certain company is clean is firstly part of our forensics team's job. The forensic team gives the clean sheet that this fellow is not stealing money. The second job is to figure out, is there a robustness in the demand for the product? In financial services, that is quite easy. I mean, I don't think anybody on this call will dispute that. We need life insurance, we need general insurance, we need asset management, and we certainly need lenders. So the essentiality bit is quite easy actually here. But the hardest part of the job remains the barrier to entry piece, right? So I'll share with you one factoid, one sort of experience of assessing barrier to entry on on a stock which we have put in CCP and which will also feature in said portfolio, HDFC Life. It took us 1.5 years of research to figure out why HDFC Life has built a barrier to entry that no other insurer has built, right? The barrier to entry in HDFC Life around big data, around data analytics, around actuarial science, and how that leads to superior underwriting, superior return on embedded value, which in turn leads to better generation of capital, reinvestment of that capital back into the life insurance business. That process took 1.5 years. And I think we must have met, in that journey, we must have met around 20 distributors of life insurance products, obviously met all the life insurers. We met several actuaries. We met around 30 ex and current staff members of the life insurance industry. That's where the hard work goes, and that's bloody hard to figure it out, right? The instinctive thing, the lazy analyst will say, boss, SBI Life, le lo, SBI Life, they got a great branch network. Or they'll say, iPru Life, le lo, iPru Life is a play on ULIPs. Right? It takes bloody hard work to figure out, of the three, which is the one with the sustainable competitive advantage, right? That's what makes a quality investing stand out. We don't try to time the market. What we spot is sectors where you can see one or two players are becoming dominant and they will drive consolidation. We have spotted the same in the financial services industry. As I said a few minutes back, the lending consolidation will be partly driven by the government not being able to finance PSU banks. And it does not matter which political party, by the way. There is no money left to finance PSU banks, right? So the lending consolidation will be driven by the government not being able to finance PSU banks. And to be fair to the ruling dispensation, they've already said there'll be basically 5 PSU banks. Everybody else can go and jump into the Arabian Sea. And then the private sector lenders consolidation will be driven by, in Tej's forensic chart, the zone of thuggery basically being decommissioned as the mutual funds stop buying their commercial paper. In asset management and wealth management, you folks are going to drive the story. And again, there it's pretty apparent who the dominant players will be, both in asset and in wealth management. And our job is to spot these opportunities and make money from it. That's why we exist. We enjoy doing it. It gives us a kick to spend year and a half researching a sector, identifying the dominant player, the one with the strongest barriers to entry, and then we put that to work once people like you give us money.
Great. This is a very interesting question. A few people have asked it. They said that one of the things I liked about Marcellus was deep understanding of a handful of companies to get to the bottom of the issue. This is Marcellus's third fund in literally less than 2 years. Doesn't that go against the grain of the Marcellus philosophy of having a concentrated list of companies so that you can get to the depths of each of these companies?
No, super question, folks. So just to give you some perspective on us, we've been working together as a group, Pramod, Rakshit and I, for 16 years. Tej has worked with me for the best part of 7 years now. Ashwin Shetty, the Little Champs fund manager, he's worked with me for 12 years now, right? So we have 12 analysts in the team and 12 analysts, fund managers in the team. And we've spent, over a decade together with each other. In that decade that we've spent together with each other, I hope you won't forgive us for figuring out around 40 odd companies in our country across large cap, small cap, mid cap, right? So CCP plus Little Champs is around 25, 26 companies. Several of you asked whether the stocks here are fresh or there'll be regurgitation of CCP and Little Champs. This portfolio is likely to be, as Tej has said, around a 10 to 14 stock portfolio, right? Assume say 13, 14 stocks. Of those 10 to 14 stocks, 7 will be drawn from CCP and LCP, and another 7 odd will be common. 7 of 5 actually, sorry, 5 will be drawn from CCP, LCP, and another 7, 8 will be unique to this portfolio. So we've got 12 analysts. Between 12 analysts, we currently look after around 26 stocks, roughly 2 stocks per analyst. The creation of this portfolio will add another 7, 8 stocks to our our coverage universe table, so to speak. And we'll end up with around 35 stocks that we have to tend and look after across a 12-man, there is 1 lady in the team. So 11 men and 1 lady, 12-person team. So that's around 3 stocks per analyst. And that gives us abundant time to spend a good year researching away a stock company before we put your money to work there. At one level, I wish there was more I could discover for you. But our journey in India across the last 12 years suggests that the list of companies that are investable across, say, the top 1,500 stocks in our country, the list of companies that are investable is probably limited to 50. Once we get KCP going on Monday, I think the first monies will flow in on Monday. Once we get KCP going on Monday, our coverage universe will be 35 out of those 50 stocks, and hopefully in due course the other 15 will bring under coverage. But 12 analysts, 3 stocks per analyst, abundant time to do in-depth research, and honestly that's the piece that we enjoy the most. We do speak in these webinars because it's a occupational thing. If we don't speak to you, how will you know what we're doing? But the real kick is doing forensics, spending time reading annual reports and doing primary data research. That's what all of us get a buzz out of, and we get abundant opportunity to do that in this job, which is why we are sitting in front of you today.
Okay, the next one is the opposite of the markets looking risky. The opposite is, well, timing is nice, but isn't it a bit too late? The last 3 months has seen significant rally in the market, and even financials have rallied somewhat. And given that the capital raising environment at these level of stock prices is healthy, won't the weak lenders also be able to bolster their balance sheet, and hence the consolidation theme get jeopardized?
So the reason Tej is a fund manager is he preempted this question. Tej, take us through that slide where you showed what happens if you invest too late and too early and so on, right? Yeah. Why timing is irrelevant.
Yeah, so say if someone would have invested not at the bottom of any of the previous crises, even if they were 3 months late, 3 months early, they would have made a healthy 23% in 2008-9, a healthy 32% in the crisis of the late 90s. And speaking of the financial stocks right now, even if we were to compare them to the pre-crisis era, they're still lagging behind the market rally. So while the market is 10, 15, 20% of its peak, if you were to compare it to the pre-crisis era, these financial stocks are still 35-40%. The bank nifty is still 35-40% of its peak, even if we were to speak about those numbers.
So let's look at it another way. That 23% number Tej gave you, right? He's saying that even if you screw up the timing, and assume we will screw up the timing, right? As I said, we have no great insight into market timing. Even if you do that, you get a healthy return. But there's another way to think about it, right? The simplest way. Tej, take us to the earnings growth slide, 19% earnings growth wala slide. So we are investing in market-leading franchises, whether it's an life insurance or lending. Life insurance, I've already given you the name. Lending, it doesn't take a genius to figure out some of the lenders in the portfolio, right? These are companies who are growing earnings, the bottom left table, earnings at 19-20%. If a company's earnings grow 19-20% year after year, right, how much return will they generate from your shareholder return perspective? Hopefully easy answer, 19-20%, right? So believe it or not, this portfolio generates the same earnings growth as Nestle with similar volatility as Nestle, right? So it sounds very counterintuitive that baby milk powder grows at 20% and so does HDFC Life, but that's actually the answer. And that's why we gravitate towards stocks like HDFC Life, HDFC Bank, Kotak Bank, Bajaj Finance. We gravitate towards stocks like this, high quality companies who have shown over 10 years, as in Tej's words, demonstrated returns of 20% earnings growth. Because if that's there, you and I will make 20%. That, provided you and I don't try to time the market, your earnings growth and your share price return are broadly commensurate to each other, and that's what you end up with if you leave market timing aside. Right? So this will be a 10 to 14 stock portfolio, somewhere between those two, and 60% lenders, 40% non-lenders, 20% earnings compounding, volatility similar to that of the Nifty, but return substantially better than the Nifty. Pramod, back to you.
Yeah, I think this has to be my favorite question. I think a couple of people have asked, but I think it's a very important thing not many people realize, which is the risk from change in management. Almost all the 4 case studies you referred to have either already seen a change in management or is impending, either in the short or the medium term. How do you address that risk as part of your investment process?
So super question. Maybe said the person who's asked the question should perhaps become part of our investment committee. We need minds like this. So folks, you can guess what subject we've spent, and I personally have worked on this over the last 12 months. Last 12 months, we've created probably the most powerful framework created in our country for assessing succession risk, right? So as this, I think the questioner is alluding to, what will happen to HDFC Bank post Aditya Puri? What could happen to Kotak Bank and what might be the post to their Kotak era, given the way the RBI is going, right? Nanu Pamnani, one of the big brains behind Bajaj Finance, passed away recently. What impact will Nanuji's demise have on this great lender, right? HDFC Life, Amitabh left and joined Axis Bank, and they had an internal succession there, right? What impact did it have on HDFC Life? So what we have done over the last year is created a framework to look at this very clinically, right? There's no emotions involved. We're not related to any of these promoter families or these CEOs or CFOs. We are here to make money, and we built a framework around three things. Firstly, basis our research, talking to staff members in these places, is there a ongoing succession planning program, not just for the big man or woman at the top, but for the CFO, the CTO, for the retail deposits head, for the retail liability franchise head? If we don't spot an ongoing succession program for every layer of the corporate hierarchy, we give lower marks to that company. Second thing, how strong is the board? In the sense, are the fellows sitting on the board drinking buddies of the CEO / promoter, or are they people that we know from our social life as strong-minded people who won't mind letting it rip at the board meeting? People who have got an independent mind and character of their own, right? So we scored the boards of these companies, right? And this is across all our portfolios, folks. So quality of ongoing succession planning at every level of the hierarchy, not just the big man, quality of the board. And thirdly, basis our analysis of incentive structures, ESOP structures, how decentralized is the compensation framework, or is it the case that the year end, Malik sits down and decides kiska bonus kitna hoga? Right? The more granularity we've picked up in our chats with DSAs, feet on street, brokers, distributors of these various companies, the more granularity, more decentralization, the more autonomy we've picked up, the greater marks we have given. Because a more decentralized construct is more robust and more able to deal with changes in management, right? So we've scored the entire, all the portfolios for that. And the same is being done to Kings of Capital. And companies which have more robust succession planning constructs, not just at the top level, I stress, right? So remember, at a lender, even more important than the CEO is potentially the head of risk. If your head of risk gets run over by a bus and you suddenly say, boss, kisko banaya head of risk and let's hire from some other place, you are screwed as a lender, because in that period when your head of risk has been run over by a bus and you have no other candidate, your loan book could blow up, right? So we've scored the companies that we are investing in, basis the rigor in terms of quality of board, quality of succession planning, and decentralization of corporate might and corporate decision making. So the more granular it is, the more higher the scores you get. Now, obviously, none of this is sort of perfect in the sense, in spite of all of this, we could get hit by a black swan. But as they say in golf, the harder you practice, the more you prepare, the luckier you get. And we seem to have been very lucky over the last couple of years in how our portfolios have performed.
Great. So I think we need to get into some of the housekeeping questions. But before that, one question on asset allocation, Saurabh. We have several of our clients, and thanks for that. They have invested in both the CCP and LCP, and they're keen to invest in KCP. And they asked this question while investing in LCP as well. How should they divide their corpus between a CCP and LCP? Now that you've thrown this into the mix, what should be the ideal split? If I have 100 rupees and I want to give all 100 rupees to Marcellus, how should I split it between CCP, LCP, and Kings of Capital?
So when we were when we had LCP open, and I suppose I'm we are really sorry that we have to close it to inflows, but we can't help it. There is no stock left in the market to buy in those counters. But when we had LCP open, when people asked us this, we said if you invested 100 rupees in CCP, invest 33 rupees in LCP, right? Because LCP is illiquid both in the sense that we can't find that much stock in some of these super sub BSE 500 names, and illiquid in the sense that were you to try to suddenly tell us one day कि मेरे को सारा पैसा वापस दो, even for us it's hard to liquidate those positions post haste because market में liquidity कम है. So we said 100 rupees in CCP, logic suggests 33 rupees in LCP. Here our suggestion will be for 100 rupees in CCP, you do 50 rupees in KCP. The liquidity here is far greater. Because HDFC Life, HDFC Bank, these are large companies, plenty of liquidity in the market. And remember, RBI has said no promoter can't hold more than 20%. So the liquidity is all out there in the market. So these are large liquid companies. And secondly, the inherent diversification in the portfolio between lenders and non-lenders, you can quite literally see in front of you in that table Tej has created how that buffers your volatility. You're getting returns comparable, returns significantly better than the Nifty or Bank Nifty with volatility which is comparable. So I would suggest if you have 100 rupees in CCP, you strongly consider putting 50 rupees in Kings of Capital.
Okay. A related question to that is, I guess you addressed the point of risk. How should one think in terms of expected returns if one is considering a 3 to 5 years investment horizon from this fund?
Tej, over to you.
Yeah, one should expect 20 to 25% out of this over a 3 to 5 year period. On top of this theme of earnings CAGR improving over the next 3 to 5 years on the basis of consolidation, on the back of credit growth coming back, one would also expect these high quality names to start growing more and more rapidly over the next 5 years as the sector gravitates and consolidates towards them.
Great. And is this a closed-ended fund like LCP? Do you have a capacity in mind? How are you thinking about how much this sort of strategy can absorb? And also, will you ever think of returning capital if at the peak of the next bull market, you reckon there are no opportunities? How should one think about that?
Hey, Tej, you want to take that first?
Yeah, sure. So in terms of capacity of the fund, definitely it's much more liquid than an LCP. So we don't expect that over the next few months or over the next year, its capacity could be filled up. But of course, there is a theoretical capacity, which anyways here CCP would also have. But we don't expect that capacity to be reached over at least next 1 year.
Just one caveat to that, folks. I think we are assuming a degree of sanity into the flows in KCP. If the flows into KCP rocket through, then we obviously could be left with a challenge that the five smallest names in the KCP portfolio, if we realize that liquidity is draining up because the fund inflows are coming very quickly, we might have to put up some sort of gate again in terms of stopping inflows. But as Tej is saying, the working expectation should be that it will remain open for a next year, couple of years. Usse zyada, we can't commit because of the sheer illiquidity at the lower end of the portfolio. The other thing is there is no exit load here, right? So because the reason there is no exit load is there is enough liquidity. If you were to tell us that you want your money back, we should be able to honor that by selling your stock in the market. In LCP, obviously, little chance. There's obviously an exit load because it is that much harder to exit those stocks very quickly.
Right. So does that mean it's going to be a relatively large cap biased? How do you think of sort of market cap bias for the fund?
Tej, average market cap, median market cap?
Median market cap 55,000 crores, but it will be the range is pretty wide. Anywhere between $500 million all the way up to HDFC Bank, about $100 billion. Median market cap being 55,000 crores.
So just to contextualize what Tej just said, consistent compounders median market cap is 1,60,000 60,000 crores. Yeah, consistent compounders. Median market cap is 1,60,000 crores. Little Champs medium market cap is the best part of say 3,000 crores. Yeah, Little Champs median market cap is 3,000 crores. So therefore, this number that Tej is giving you of 10,000 crores, did you say, Tej?
55,000 crores.
55,000 crores, right. So 50,000 crores is basically halfway or somewhat halfway between the punchy market cap of consistent compounders, 1,60,000, and the incredibly low market cap of Little Champs. And that gives you a sense of why we had to shut Little Champs, because those really are precious gems. 3,000 crores companies with dominant positions in sectors which are essential to life. So this is more liquid, mercifully, than Little Champs, and hence we should be able to keep it open for a couple of years at least.
And how do you look at deployment? Typical Marcellus style, pretty much deploy immediately, taking liquidity into account, or given there's an element of timing here, will you sort of wait it out?
Tej?
Yeah, we'll deploy immediately, just like we do in all other funds, taking liquidity into account.
Great. Just one last housekeeping question. A lot of you have asked that if you can split your 50 lakhs across all three funds. I'm afraid we can't. I mean, this is a 50 lakh limit for each of Marcellus's strategies, and it's not a regulatory constraint. It is a Marcellus requirement that you need to invest at least 50 lakhs in each one of them. There are a few questions we are avoiding about what do you think of specific subsectors like depositories and rating agencies and stock exchanges. I think given the literally each of these subsectors have one stock, I don't think we would like to comment at this stage. Over time, as we publish our newsletters, there will be more commentary on the portfolio composition. So until then, folks, thank you very much for dialing in. Feel free to write to us if you have any further questions. Feel free to write to your wealth management partner. Happy to answer as many questions as we have. Until then, have a good weekend and stay safe.
Thank you.
Thank you.